Welcome to BusinessVille. Today we're going to be talking about the recent collapse of Silicon Valley Bank in the UK. And how the approach taken by UK authorities differs from the US approach. This has been a hot topic lately, especially with the sale of SVB UK to HSBC and the way in which UK policymakers handled the situation. It's important to understand these differences and their implications for small tech startups and the wider financial market. What happened with Silicon Valley Bank UK? On March 13th, the UK Treasury and Bank of England announced that they had facilitated the sale of SVB UK to HSBC in a manner that protects all depositors and gives them immediate and full access to their funds. This was a huge relief to small tech startups in particular that, like their brethren in the US, had a significant part of their banking activities at a lender widely seen as especially sympathetic to their operations. However, the approach taken in the UK is different from the one in the US. Specifically, the authorities there opted for a no-limit guarantee to SVB depositors, setting aside the official mechanism that ensures deposits up to $250,000. In parallel with this, the Federal Reserve opened a special window for all banks to provide cash for 1 year at preferential terms in exchange for certain high-quality assets. Why did the UK take a different approach? One way to explain this difference is by looking at the significantly smaller size of SVB UK. After all, it is inherently easier to find a buyer for a small institution. It also means that an already big bank, such as HSBC, does not become appreciably bigger. However, there is more in play. The UK authorities, and the Bank of England in particular, have repeatedly appeared in the recent past to be more hesitant than their US counterparts when it comes to offering widespread guarantees, opening year-long funding windows, and allowing monetary policy to become hostage to financial stability drivers. This may well be the case again. The UK's aversion to moral hazard and co-option of monetary policy. The UK authorities, and the Bank of England in particular, have a stronger aversion to the twin risks of moral hazard and co-option of monetary policy by financial markets. The way they dealt with the SVB crisis highlights not just the less complicated operational conditions faced by UK policymakers, but also their aversion to these risks. Remember what happened in the UK a few months ago amid the financial turmoil triggered by the mini-budget of former Prime Minister Liz Truss. Yes, the Bank of England felt compelled to intervene to provide assistance to troubled liability-driven investment entities, but did so with a clearly communicated timeline and limits. The Bank of England has been concerned that more open-ended support, especially if it is generalized, risks encouraging excessive risk-taking. It has also been careful to minimize the risk of monetary policy being hijacked by financial stability considerations, an approach that most economists would commend, especially when inflation is still a problem. US approach to financial stability. On the other side of the Atlantic, the Fed seems to have been less worried about having its monetary policy co-opted by financial markets as it sought to calm volatility. This has been evident in several small ways in the last few years, including in 2018 to 19, and again in 2020 to 21. Markets are now making it obvious in a big way by taking the probability of a 50 basis point interest rate increase by the Fed next week from 2/3 to 0. In fact, the markets are not even favoring a lower 25 basis point increase. Rather, the pricing of no hikes is being accompanied by a much lower peak rate for this cycle. The difference in the approaches taken by the UK and US authorities highlights a broader issue when it comes to financial stability. While both countries prioritized financial stability, their approaches differ, and each has its advantages and disadvantages. The UK's approach emphasizes minimizing the risks of moral hazard and co-option of monetary policy by financial markets, while the US approach prioritizes calming market volatility and providing liquidity to the financial system. The sale of SVB UK to HSBC was a significant event that highlighted the differences in approach to financial stability between the UK and the US. The UK authorities' private sector solution of providing a no-limit guarantee to depositors, while setting aside the official deposit insurance mechanism, reflects their aversion to moral hazard and co-option of monetary policy by financial markets. As individuals, it is essential to understand the implications of these different approaches on financial stability and be aware of the potential risks and benefits of investing in financial institutions. It is also essential to stay informed and up to date on the latest developments in the financial world to make informed decisions. So, what do you think of the different approaches taken by the UK and US authorities to ensure financial stability? Which approach do you think is better, and why? Let us know in the comments below. And don't forget to subscribe to our channel, BusinessVille, for more insights and analysis on the latest business and financial news.